Vancouver has a rental vacancy rate sitting below 2%. If you're out there trying to rent an apartment right now, you already know what that means. You are fighting hard against a lot of people for almost nothing. Now, hold that fact in your head, and then hold this one right next to it. As of January 31st, 2026, there are 12,628 homes listed for sale on the MLS in Metro Vancouver, just sitting there, waiting. 12,628 properties that someone desperately wants to sell, and almost nobody is buying. That number isn't just a myth, it's actually coming directly from the Greater Vancouver Realtors' official monthly statistics released February 3rd. Total sales in that same month? 1,170. Let that ratio exist in your head for a second. 12,628 available, 1,170 sold. That is a sales to active ratio of 9.1%. In a balanced market, that ratio sits between 12 and 22%. We are at 9.1. We are not nudging the edge of a buyer's market. We are structurally deep inside one. That translates to 11.4 months of inventory across all property types. For the detached home specifically, 14.9 months. A balanced market is 4 to 6. If you listed a detached home in Metro Vancouver today, the absorption math says you're statistically looking at over a year to find a buyer. Not worst case, that's what the current numbers imply. And the 10-year average for active listings in this market is 9,153. We are at 12,628. That's 38% above long-term normal. The most recent reports show inventory jumped another 41% month over month, 41% in a single month. We'll come back to what that acceleration actually signals. But wait, why are 12,628 homes sitting on the market in the first place? A meaningful share of those 12,628 listings are investment properties, condos bought with the expectation of positive cash flow, or at minimum, a manageable monthly position. What's happened to that math over the last 2 years is brutal. Take the most common scenario in the research, a 2-bedroom condo in Burnaby, purchased for around $1.2 million. Yes, Burnaby. We're not even talking about downtown and not a mountain view. Burnaby. With 20% down, you're carrying a $960,000 mortgage. Lock in at 1.99% in 2021, which people were genuinely getting, and your monthly payment was around $4,600. Rental income on a 2-bedroom in Burnaby ran $3,200 to $3,400. Factor in strata fees, property tax, insurance, maintenance, and your total costs were $6,500 to $6,800 a month. Not quite break even, but manageable. And with prices still rising, equity appreciation was doing the heavy lifting. The logic held. Then renewal day arrives. At current variable rates around 5.19%, that same $960,000 mortgage now costs approximately $5,800 a month. That's an extra $1,200, and it doesn't phase in. It hits the moment you sign. Meanwhile, BC's rent cap limits increases to 3.5% in 2026. So if your tenant was paying $3,200, you can raise it to $3,312. The mortgage went up $1,200, the rent went up $112. Add strata fees, newer towers are running $950 to $1,100 a month, property tax around $300, insurance $150, maintenance $200. If the unit sits vacant, BC's empty homes and vacancy taxes can add thousands per year. The research puts the total monthly carrying cost in a clear range. At minimum, for owners who renewed recently and have a tenant, the net monthly loss is $1,500 to $2,200 every single month. For owners in the worst-case scenario, that number stretches to $5,400 per month negative. The cash flow that looked functional back in 2021 has completely inverted now. Here's where it gets genuinely grim. You might think, okay, it's painful, but I'll sell and pull my money out. Except the apartment benchmark price in Metro Vancouver is down 10.15% year over year as of January 2026. A property you bought for $1 million in 2022 might appraise at $900,000 today. Your outstanding mortgage is still $800,000. After closing costs, you walk away with less than the math suggests. And if you try to refinance, the bank stress tests you at 6.5%. Most renewal investors don't qualify. So here's where the owner actually stands. You can't sell without locking in a loss. You can't refinance your way to a better rate, and you can't hold without losing your money every month. That is not a tough choice between options. That is no good choice at all. This is what researchers are calling the trap, and it's why so many of those listings are sitting for months with repeated price cuts and zero movement. But what came next would shock even those who thought they understood where this crisis was concentrated. The obvious assumption most people make when they hear Vancouver condo oversupply is that we're talking about downtown, luxury towers, developers sitting on $4 million suites. That narrative is clean, easy to be angry about. And let me tell you how it's almost entirely wrong. 71% of the distressed and unsold inventory across Metro Vancouver is in suburban municipalities. Burnaby accounts for 35% of the empty and unsold condo overhang, over 4,000 units clustered around Metrotown and Brentwood Station alone. Coquitlam is 22%, mostly around Lockheed Town Centre. Surrey 14%, Richmond 12%, North Vancouver 8%. Downtown Vancouver proper, the actual urban core, is roughly 9% of the problem, 275 units out of more than 3,000. Let that sink in. The place where housing is supposedly always in demand, where the luxury narrative lives, that's 9% of this actual crisis. The real problem is in Burnaby, Coquitlam, Surrey, the exact suburbs marketed as the safe, transit-oriented, practical choice. Brentwood Station, Metrotown, these were sold as infrastructure-backed investments. The SkyTrain is right there, safe, growing, equity building. It's called a strata special levy, and it's the risk hiding inside these towers that almost nobody running monthly cash flow math has included in their calculations. The problem is that it requires consistent contribution from all unit owners. So what happens when 30 to 40% of a building is vacant, developer-owned, or caught in a default process? The developer finishes the building. Some units sell, many others don't. The developer still technically owns 30 to 40% of the floors. And in documented situations, strata fee contributions from those developer-owned units are not being made at the rate the reserve fund needs. Meanwhile, the building ages. Maintenance comes due. Elevators do not care what interest rates are doing. Take a standard 200-unit tower, where total replacement cost around $80 million. The reserve fund should sit at roughly 20% of that, $16 million. Annual strata budget around $2.4 million, about $1,000 per unit per month. If 30 to 40% of units stop contributing properly, the fund develops a shortfall, and when the building needs work, the remaining contributing owners cover that gap. In scenarios where this has happened, and researchers have identified this as a real documented condition in specific Burnaby and Coquitlam buildings right now, the special levy assessment can reach approximately $60,000 per unit. Now let's put that in context. The owner of a Burnaby condo already negative $1,500 to $2,200 every month, holding something worth less than they paid, can't refinance, can't sell without locking in a loss. That same person now faces a $60,000 special assessment that cannot be declined, arrives on a fixed timeline regardless of their financial situation. And the feedback loop from there is totally mechanical. Some owners can't pay, the levy gets recalculated across fewer contributors, per unit cost rises, more defaults, more cascade. The polite term for what follows is strategic default. You hand back the keys, 7 years of damaged credit. Property gone. This is the risk that doesn't show up in the price indexes, and it compounds everything else. There's a real counterargument here, and it deserves an honest presentation. Someone who's been buying Vancouver property for 15 years and currently holds 3 condos recently offered this. Vancouver doesn't build enough. It never has. The structural supply constraint is real and persistent. Population may be adjusting short-term, but this is one of the most desirable cities on the continent. Land is finite.
Geography constrains development. That doesn't change. And rates will come down, maybe not to 2%, but meaningfully. When they do, sidelined buyers come back. He believes that 2027 looks completely different from nowadays. But here's the problem. Inventory is 38% above the 10-year average. The 9.1% sales to active ratio does not respond quickly to incremental rate changes. A 50 basis point Bank of Canada cut changes the monthly payment on a $960,000 mortgage by roughly $250. That obviously helps. It does not transform deeply negative carrying cost math into viable. It's a dent, not a solution. So, one structural piece, the bullish scenario, underweights significantly the pre-sale investor market, the engine that funds new construction. Developers need 70% pre-sale thresholds to access construction financing. Investor participation in pre-sales was around 50% in 2021, and it dropped below 20%. Based on the most recent data, it's now at approximately 7%. The entire construction financing model was built on investors hitting that threshold. At 7%, there is no model. The pipeline of future supply isn't slowing, it's almost freezing, guys. And then came the banking picture, which is where this stops being just a real estate story. Researchers have identified 3,590 empty and unsold completed condo units across Metro Vancouver. Finished buildings ready to move into, sitting vacant. Those units have construction loans behind them, typically at 70% loan to value. If 20 to 25% of those loans become non-performing, the potential write-down for Canadian banks on Vancouver condo exposure lands between $500 million and approaching $1 billion. To be more precise, major Canadian banks are well capitalized. CET1 ratios sit around 13.5%, well above the 11% regulatory minimum. Nobody is going bankrupt over this. What it does create is real pressure on bank equity valuations, a variable that simply wasn't there a year ago. Bank provisions rose roughly 25% in Q4 2025 on renewal-related risk, and roughly 60% of all outstanding Canadian mortgages are coming up for renewal in 2025 and 2026, many locked in under 2%. The banking system is simultaneously absorbing developer loan stress, a nationwide mortgage renewal shock, and softening collateral values. Each one is manageable in isolation. The overlap is what deserves serious attention. When you aggregate the cash flow stress across all 12,628 listings, and this is a directional estimate, not an audited figure, the Metro Vancouver market is burning through approximately $6.5 billion in negative cash flow annually. The construction freeze compounds it. For every single tower that gets shelved, roughly 500 direct and indirect jobs disappear over a build cycle. The estimate across BC from the current pipeline freeze is upward of 5,000 construction jobs at risk. On the government revenue side, property transfer tax revenue projected to drop roughly 60% from peak. Development levies down around 80%. Combined with reduced corporate tax from the sector, that's approaching $830 million in lost provincial revenue. Less money in, more demand for support programs out. A bad combination for any government trying to respond. That's crazy. The January and February numbers are pure facts. 12,628 active listings, 9.1% sales to active ratio, 14.9 months of supply on detached. Apartment benchmarks down 10.15% year over year, 41% preliminary inventory jump in February, pre-sale investor participation at 7%. Those don't require a model. They're already there. But here's the honest range of outcomes. The highest probability scenario, roughly 40%, is gradual deterioration with a feedback loop. Inventory builds. Developers with unsold stock can't service construction loans. Forced sales at 20 to 30% below original ask reset comparable data for every similar building in that suburb. Bank lending tightens. Fewer qualified buyers. More inventory pressure. More forced sales. Condo prices ending 2026 dropped down 20 to 25% in that path, a correction with momentum. Managed decline, rates stable, inventory clearing slowly, prices down around 15%, sits at about 35%. A soft landing where rate cuts arrive faster and sideline buyers return in volume is actually possible but sits at roughly 15%.
A severe correction involving recession and widespread developer failures is around 10%. Even CMHC's own published projections show a national sales to new listings ratio of 32.7%. A healthy market runs at 57. The Federal Housing Authority is essentially publishing data that confirms the managed decline to faster deterioration range. And Rennie Intelligence's head economist recently described the current condo market with 5 words. The market is out of gas. These words are not random ones. It's someone inside the industry at one of BC's major real estate advisory firms talking. That is the kind of sentence you file away. Now, here's the part most housing coverage skips: the renter picture. Short term, if a share of those 12,628 listings flows into the rental market because the units can't sell, supply increases. Rents might ease 5 to 10%. A 2-bedroom moving from $3,200 to maybe $2,800 in some suburbs. Real money, but the construction freeze is the other side of that math. The pre-sale pipeline that would have brought new rental supply online in 2027 and 2028 is frozen. The cranes come down. Nothing gets built behind this current inventory. When this surplus eventually gets absorbed, there's nothing waiting behind it. Comment below what you think about this situation.